Look at your portfolio right now. Seriously, open the app. Whether you know it or not, the ground beneath the financial system is shifting, and what is happening to silver right now is about to impact every single dollar you have saved. I'm not talking about some slow-moving trend that will play out over the next decade. I'm talking about a fundamental fracture in the global economy. We just saw gold surge 65% in a single year, the biggest gain since 1979. But while everyone is watching gold, the smart money, I'm talking about the people who actually run the world's financial plumbing, is quietly positioning for something much more explosive. Silver. Here is the terrifying part. While silver is screaming danger, the stock market is partying at all-time highs. Those two things do not happen together unless something is breaking under the surface. The US government is trapping itself in a debt spiral. China is weaponizing its reserves, and the industrial demand for silver is colliding with a currency crisis. By the end of this video, you are going to understand exactly why the US dollar is under attack, why China is hoarding physical metal, and why silver might be the only fire insurance left for your wealth. Let's put this into perspective. For the last 40 years, the playbook was simple. You buy stocks, you buy bonds, and you trust the US dollar. It was boring, it was predictable, and it worked. But looking at the last 12 months, that playbook isn't just broken, it's being incinerated. We are seeing the biggest annual gain in precious metals since the Jimmy Carter era. This is not normal market behavior. This is assets on steroids, chugging energy drinks at 3 a.m. because they know a crash is coming. The mainstream media, CNBC, Bloomberg, they want you to believe this is just about inflation. They tell you silver is up because your groceries cost more. And sure, inflation sucks. But if this was just about inflation, silver and gold would have exploded in 2021 when the Fed printed $4 trillion and inflation hit 9%. They didn't. They went sideways. So why now? Why in late 2025 and entering 2026 is the metal market going parabolic? Because this isn't about the price of goods, it's about the value of the currency itself. The US national debt is now over $38 trillion. We are adding $6 billion in debt every single day. Interest payments on that debt are now over $1 trillion a year, more than the US spends on its entire military. The US government has two choices: default on the debt, which destroys the economy, or print money to pay it off, which destroys the dollar. They are choosing option 2. And the rest of the world, specifically China, knows it. 1. The silent war, de-dollarization. This is the part the news won't tell you. Foreign countries, the foreign buggers, as we might call them, are quietly losing faith in the US dollar. And when I say quietly, I mean the same way someone quietly deletes their couple photos on Instagram before announcing a divorce. The signs are there, people just pretend not to see them. For 80 years, the dollar was the only game in town. But look at the central banks. 20 years ago, 70% of global reserves were in dollars. Today, it's 58%. That 12% drop represents trillions of dollars being dumped. They aren't just selling dollars. They are diversifying into assets that have no counterparty risk. If you hold a US bond, you are trusting the US government to pay you back in money that is worth something. Right now, nobody trusts that. So they buy gold. But here is where the economic war with China gets interesting. They are looking at silver. To China's strategic stranglehold. China is not just buying gold for its vaults. China is the world's factory. They understand something that Wall Street bankers, who sit in air-conditioned offices moving pixels around on a screen, often forget. You cannot print silver. We are in a technological Cold War. Solar panels, EVs, military-grade electronics, they all require silver. It is the most conductive metal on Earth. You can substitute it easily. While the US plays games with paper derivatives and debt, China is securing physical supply chains. If the US dollar weakens, the cost to import silver into the US skyrockets. If China decides to restrict exports of processed silver or hoard it for their own solar initiatives, the West faces a supply shock that no amount of money printing can fix. This is a squeeze. The West is short on physical reality, and the East is long on hard assets. 3. The island theory of value, coast. Let me explain why silver prices rising is mathematically guaranteed unless the US changes course, which they won't. Imagine a tropical island with 10 castaways. There are only 10 $1 bills on the entire island. That's the entire money supply. Prices are stable. Now, a guy washes ashore with a suitcase containing $100. Suddenly, the island goes from having $10 to $110, but there are still the same amount of coconuts. What happens? The price of everything must go up. The coconuts didn't get better. The money just became worthless. The U.S. Federal Reserve is that guy washing ashore, except he's arriving every single day with a new suitcase of cash to pay off the interest on yesterday's debt. In this environment, holding cash is guaranteed poverty. Holding bonds is guaranteed losses. The only way to preserve purchasing power is to hold the asset that the new money cannot dilute. That is why silver isn't just an investment, it is a lifeboat. 4. The market anomaly: stocks versus reality. So, why is the stock market at an all-time high? Why does everything look fine? Because the market is drunk on liquidity. When the government lowers interest rates to make their debt affordable, that money flows into stocks. It creates a wealth illusion. The stock market went up 20%. Great, but the currency you measure it in lost 15% of its purchasing power. You didn't get richer, the numbers just got bigger. Real inflation is found in assets, real estate, stocks, and now precious metals. The difference is, stocks are priced for a perfect future where AI solves everything and earnings grow forever. Silver is priced for the reality, a future of debt debasement, geopolitical conflict, and the end of the dollar's hegemony. One of these markets is wrong. And historically, the bond market and the gold market are the smart money. The stock market is usually the last one to realize the party is over. It's not just governments. Look at the corporate sector. Major industrial giants are starting to realize that just-in-time delivery doesn't work when currency wars break out. We are seeing signs of companies bypassing the futures market, the paper market, and demanding physical delivery of silver. Why? Because they don't trust the paper contracts. If you are a CEO of a solar company, you don't care about the spot price of silver on a computer screen. You care about having the metal in your factory so you can build your product. When trust erodes, premiums on physical metal explode. We are approaching a point where the paper price of silver, manipulated by banks, and the physical price of silver, dictated by real demand, will decouple. And when that snaps, the rally will be violent. So, what does this mean for you? I'm not a financial advisor. I'm just a guy who reads the data that Wall Street tries to bury. But here's the reality. The forces driving this, the $38 trillion debt, the breakdown of U.S.-China relations, the weaponization of currency. These forces aren't going away. If anything, they are accelerating. The U.S. government is trying to pull the wool over your eyes. They want you to focus on the nominal high of your 401 kilobits while they devalue the currency underneath it. It's a magic trick. You need to think of silver and gold not as investments that you flip for a quick buck, but as fire insurance. You don't buy fire insurance because you want your house to burn down. You buy it because if it does, you don't want to be left standing in the ashes with nothing. The central banks are buying insurance. China is buying insurance. The billionaire class is buying insurance. If the smartest money in the world is quietly repositioning out of the dollar and into metal, maybe it's time you asked yourself, why aren't you? If you want to survive the greatest wealth transfer in history, you need to pay attention. Share this video with someone who thinks everything is fine, because everything is not fine. But for those who are prepared, it's the opportunity of a lifetime. Thanks for watching. I'll see you in the next one.
Reuters has just released its latest macroeconomic report titled "Gold Prices Slip Lower as U.S. Inflation Figures Firmer, Dollar Rises." On the surface, the market appears to be reacting strictly according to the textbook. When the U.S. dollar index, DXY, strengthens, algorithmic trading models automatically trigger sell orders for precious metals. The investing crowd is currently focusing their attention on gold, assuming the upward trend has stalled due to the hawkish macro environment. However, if we look deeper into capital flow data and the underlying market structure, a massive anomaly is currently unfolding in silver, one that retail investors are largely missing. While short-term price charts indicate selling pressure driven by high-frequency trading algorithms, the actions of smart money in institutional accumulators are telling a completely different story. This is not a sell-off to exit positions. Quantitative data suggests this is a classic liquidity shakeout. we are witnessing a sharp divergence between the paper price, futures contracts, and the physical price, real metal. While the paper price dips, physical premiums are rising. This mechanism is designed to flush out weak hands and leveraged speculators, allowing institutional players to acquire positions at a discount before the market establishes a new price floor based on actual, undeniable physical supply scarcity. Let's dive into a forensic analysis of the market data to understand the gravity of the situation. In October 2025, China made an unprecedented move, exporting 660 tons of silver in a single month. To put this in perspective, this volume exceeds their typical annual export quota and runs completely counter to the strict strategic resource controls Beijing implemented earlier this year to protect supply for its domestic solar manufacturing base. According to basic economic laws of supply and demand, when such a massive supply shock hits the global market, asset prices should drop sharply due to the sudden surplus. But what is the reality? Silver prices not only didn't crash, but they also continued to break historical highs, surpassing $66 per ounce this December. Why this paradox? The answer lies in the rapid depletion of the Shanghai Futures Exchange's stockpiles. Data shows that silver inventory in Shanghai has collapsed. From a peak of 3,911 tons in January 2021, only about 780 tons remain today. Effectively, they have burned through nearly 80% of their strategic reserves in less than 5 years. The export of those 660 tons was not a commercial sale of surplus inventory. It was an emergency liquidity injection for the London Bullion Association. The London market is currently facing severe backwardation, a condition where current prices are higher than future prices, signaling a physical squeeze. China was forced to act as the supplier of last resort to arbitrage the price difference and prevent a breakdown of the global pricing mechanism. So where did that massive amount of silver go? It didn't stay in London vaults. Import data reveals a massive shift of physical capital towards India. In just September and October alone, India imported a staggering 2,600 tons of silver. The metal flows are moving from Chinese reserves through London and Hong Kong intermediaries and are being completely absorbed by India. This is not just jewelry demand. It is a strategic accumulation by Indian industrial conglomerates preparing for their own green energy transition. This leads us to the bigger picture regarding fundamentals, which are currently stronger than at any point in the last 50 years. The year 2025 marks a collision between two opposing forces, inelastic demand versus finite supply. On the demand side, we are seeing inelastic industrial demand. The global transition to net zero relies heavily on silver. Solar. The latest TOPCON and HJT solar cell technologies require 20 to 50% more silver per panel than previous generations. This is a classic example of Jevons paradox. As solar technology becomes more efficient and cheaper, total adoption skyrockets, driving aggregate silver consumption higher, not lower. AI and tech. As we build out massive AI data centers, the need for high-performance connectors and switches is exploding. Silver has the highest electrical conductivity of any element. It has no substitute in these high-efficiency applications. Manufacturers are forced to buy silver, regardless of the price, whether it is $30 or $100, to keep multi-billion-dollar production lines running. Crucially, we must also consider the geopolitical risk premium. Silver is transitioning from a monetary asset to a strategic national security asset. Major producing nations like Mexico and Peru are increasingly discussing resource nationalism policies. If these governments decide to increase royalties or nationalize mines to capture more revenue, the global supply chain faces an immediate shock. We are moving away from a globalized free trade market for minerals to a fragmented protectionist environment. On the supply side, the situation is critical. We are facing a structural deficit. Mining output is flat or declining due to years of capex starvation and falling ore grades. Furthermore, 70% of silver is mined as a byproduct of zinc, lead, and copper. Even if silver prices double, copper mines will not ramp up production just to get a little more silver. This supply inelasticity means the market simply cannot respond quickly to the demand shock. So, what is the scenario for the near future? At the current burn rate, the visible inventory in Shanghai is sufficient for only about 2 more weeks of trading. When this buffer disappears, the market enters uncharted territory. We anticipate a decoupling event. This occurs when the paper market, futures, derivatives, and the physical market break their correlation. Currently, the paper market operates on massive leverage known as rehypothecation. It is estimated that for every ounce of physical silver in the vaults, there are potentially hundreds of paper ounces traded. As long as investors are happy settling in cash, the game continues. But when industrial buyers, who need the metal for production, start demanding physical delivery that the COMEX or LBMA vaults cannot meet, the system breaks. Exchanges may declare force majeure and force cash settlements. This is the ultimate short squeeze. Short sellers will be forced to cover their positions at any price, pushing the price chart vertically to find a new equilibrium where demand is finally destroyed, a price likely much higher than today's levels. My strategic advice for investors is as follows. Do not let short-term volatility based on CPI prints or Fed speeches distract you from the geological reality. We are looking at a mathematical certainty of depletion at current prices. Institutional allocation to silver is currently less than 0.5% of global assets. If that allocation merely shifts to 1%, the buying pressure would be overwhelming. Silver is currently in the most attractive valuation zone relative to its growth potential. The gold-silver ratio is currently hovering near historical extremes. If this ratio reverts to its historical mean of roughly 60-1, or the geological ratio of 15-1, the upside potential for silver presents a highly asymmetrical risk-reward profile. This is a phase of wealth transfer. It is a transfer from those holding depreciating currency and unbacked paper contracts to those holding essential, finite, real assets. Ensure you are on the right side of this transfer. Today is December 22, 2025. We're witnessing silver trading around the $58 per ounce mark, a price level approaching historical highs. However, in today's in-depth report, I invite you to temporarily look past the short-term price fluctuations on your tickers and focus instead on a structural shift that is occurring quietly but decisively beneath the market's surface. Typically, when an asset experiences a sharp rally, our immediate concern is whether the market is overbought. Yet, current analysis of capital flows and physical inventory data tells a completely different story. We are not looking at a short-term speculative bout, but rather the inception of a systemic supply crisis. My core thesis in this report is as follows. The silver market is entering a new phase of price discovery, driven by the convergence of 3 factors: a prolonged structural supply deficit, irreplaceable industrial demand, and most importantly, a paradigm shift in the strategic reserve policies of Eastern powers. Let us begin with the most critical macroeconomic factor that the mainstream media is largely overlooking: the actions of sovereign actors. 2024 marked a historic turning point when the Russian Ministry of Finance officially allocated a budget of $535 million, approximately 51 billion rubles, for precious metals purchases over the 2025-2027 period. What is notable here is not just the figure, but the asset class. For the first time in over 50 years, silver has been classified as a national strategic reserve asset, alongside gold, platinum, and palladium. Why is this a critical signal? For 170 years, central banks have demonetized silver, relegating it to a purely industrial role. Russia's move represents a reversal of this century-long trend. Analyzed through the lens of geopolitical risk management, this is a calculated move to sanction-proof national assets. Following the freezing of $300 billion in foreign exchange reserves in 2022, nations like Russia and the BRICS Plus bloc have realized a hard truth. Only physical assets located within domestic vaults are truly free of counterparty risk. Alongside Russia, we must address China, the world's factory. Although China possesses the world's third-largest silver reserves, approximately 70,000 tons, import data reveals an unusually voracious appetite. China currently controls over 80% of global solar panel production and is growing its electric vehicle manufacturing at a rate of 40% annually. Both industries view silver as an irreplaceable input material. If we examine China's gold accumulation model from 2015 to the present, there is a strong basis to assert that Beijing is applying a similar strategy to silver, strategic accumulation to secure its industrial and technological dominance for the coming decade. The fact that the world's second and 11th largest economies have simultaneously shifted to a net buyer status for physical silver will create a hard price floor, regardless of short-term currency fluctuations. Now, let us drill down into the specific numbers from the Silver Institute and global mining data. A value investor always looks at the fundamentals, and silver's fundamentals are currently in their most severe state of imbalance in modern history. 1. Structural deficit. We are entering the fifth consecutive year of a silver market deficit. In 2024, total demand reached 1.16 billion ounces, while total supply, including mining and recycling, reached only 1.01 billion ounces. This resulted in a deficit of 148.9 million ounces in a single year. If we calculate the cumulative deficit from 2021 through 2024, the world has consumed a net deficit of 678 million ounces of silver. To put this in perspective, this figure is equivalent to wiping out 10 months of total global mining output. This volume has been drawn from above-ground stockpiles and consumed permanently. It is not returning to the market. 2. Inelastic industrial demand. Unlike gold, which is primarily an investment asset, silver is an essential industrial metal. Industrial demand hit a record 680.5 million ounces in 2024. The primary drivers are the renewable energy and high-tech sectors. 3. Supply inelasticity. This is the Achilles heel of the supply side. Approximately 70% of global silver output does not come from primary silver mines, but is a byproduct of copper, zinc, and lead mining. What does this imply? It means that even if silver hits $100 an ounce, mining companies cannot simply increase silver output if the prices of copper or zinc do not justify expanding operations. Furthermore, supply from primary silver mines is in secular decline, as easily accessible high-grade deposits have been depleted. Permitting and constructing new mines takes 5 to 10 years. We cannot expect any short-term supply surge to alleviate this pressure. As risk managers, we must pay particular attention to the state of certified inventories. This is the market's liquidity buffer, and this buffer is thinning at an alarming rate. At the COMEX USA, registered silver, inventory available for immediate physical delivery, has plummeted by over 50% from 152 million ounces in 2021 to approximately 73 million ounces by late 2024. In London, LBMA, inventories are also at record lows. After deducting holdings allocated to ETFs, the actual free float remaining is negligible. The danger lies in the leverage ratio within the paper market, derivatives. Currently, open interest on the COMEX exceeds the actual physical silver involved by multiples. The ratio of paper claims to registered ounces is at extreme levels, estimated around 18 to 1. This creates a risk of a short squeeze, similar to the nickel event on the LME in 2021, but on a much larger scale.
When sovereign nations or major industrial entities demand physical delivery instead of cash settlement, the market will face an immediate liquidity shock. The divergence between the spot price and the actual cost to secure physical metal, physical premium, will widen. In such a scenario, the price listed on the exchange may no longer reflect the true value of the metal. So, is the current price of $58 to $61 the top? To answer this, we must place it within the context of comparables and inflation. First, regarding the gold-silver ratio. The ratio currently sits at 72 to 1, with gold at near $4,200. The historical average typically ranges from 40 to 1 to 60 to 1, and in bull markets, this ratio can compress towards 15 to 1. If this ratio reverts to the mean, given the current gold price, the fair value of silver should lie between $150 to $200 per ounce. Second, regarding inflation-adjusted price, the 1980 silver peak was $49. Adjusted for CPI inflation, that price is equivalent to approximately $170 in today's purchasing power. Thus, at current levels, silver remains significantly undervalued compared to its peak purchasing power in the past. 2026 to 2027 outlook. Based on the supply-demand model and macroeconomic factors, rate cuts, weakening USD, geopolitical tension, I forecast that the silver bull trend is sustainable and structural. We cannot rule out significant volatility due to spasms in the derivatives market. However, the risk is heavily skewed to the upside. When inventories breach critical technical thresholds, for example below 50 million ounces at COMEX, market sentiment will shift from speculation to panic buying to secure production supply. The current texture of the silver market is not merely a standard commodity price fluctuation. We are witnessing the convergence of a perfect storm. The greatest investment opportunities often arise when the market realizes the dislocation between price and value, and with silver, that gap is wider now than ever before. Thank you for your attention.
Stop. Take a breath. Look at the markets around you. Nvidia is breaking records. Bitcoin is making headlines. The S&P 500 is partying like there is no tomorrow. But amidst this cacophony of greed, there is a silence, a heavy, unnatural silence surrounding one specific asset. I'm talking about silver. To the untrained eye, the silver chart looks dead. It looks stable. It looks like an asset that time forgot. But if you have been in this game as long as I have, you know that stability is a lie. In the financial jungle, when the water recedes from the shoreline, it doesn't mean the ocean is calm. It means a tsunami is building. Wall Street wants you to look at the price tag, let's say $30, $32, or whatever the algorithm decides today, and believe that is the value. They want you to believe that silver is abundant, that it's just a pet rock for conspiracy theorists, but they are lying to you. We are witnessing one of the greatest misdirections in financial history. While the paper price on your screen is being suppressed by high-frequency trading algorithms and massive short positions, the real metal, the physical bars, the coins, the industrial grain, is vanishing. It is being drained, it is being hoarded, and it is happening right under your nose. This isn't a market correction. This is a crime scene. And today, we are going to walk through the yellow tape, ignore the mainstream media's distraction, and look at the blood on the floor. Let's put on our forensic gloves and dig into the mechanism of this fraud. We need to talk about the rehypothecation of silver. It's a fancy word, isn't it? But in simple English, it means selling what you don't own. If you look at the COMEX, the Commodity Exchange, or the LBMA in London, you will see millions of ounces of silver being traded every single day. Volume is high, liquidity looks deep, but here's the dirty secret they don't want you to know. For every single ounce of physical silver sitting in a vault, there are upwards of 200 to 300 paper claims floating around the market. Think about that. 200 people hold a piece of paper that says, "I own 1 ounce of silver," but there's only 1 ounce in the vault. What do you call a bank that lends out the same dollar to 200 people? You call it a Ponzi scheme, but on Wall Street, they call it futures trading. My team has been tracking the registered category in the COMEX vaults. Registered means silver that is actually available for delivery, silver that can be bought and taken home. That number has plummeted to historic lows. It is hemorrhaging. The vaults are bleeding out. So who is selling? The commercials, the big bullion banks. They use massive spoofing orders and naked shorts to slam the price down every time it tries to rally. Why? Because if the price rises too high too fast, their short positions will blow up. They are trapped in a cage of their own making. They must suppress the price to survive. But here's the catch. You can suppress the price of paper indefinitely. You can print unlimited contracts, but you cannot print metal. Eventually, the physical buyers, the people who want the actual bar, not the paper receipt, will show up at the counter, and when they ask for their silver, the teller is going to look at the empty vault and panic will set in.
Now let's zoom out. Why is this shortage absolutely inevitable? Why is this different from 1980 or 2011? Because the world has changed. Silver is no longer just money. Silver is the strategic imperative of the 21st century. We are moving into an era of the electrification of everything, and physics dictates one simple truth. Silver is the most conductive metal on the periodic table. You cannot cheat physics. Solar energy. The world is racing toward net zero. Solar panels are being installed on every roof from California to Shanghai. Newer, more efficient panels, like TOPCon technology, use twice as much silver as the old ones. The solar industry alone is swallowing nearly 20% of the annual mining supply. The AI revolution. You think artificial intelligence is just software? Wrong. AI runs on chips. It runs on servers. It runs on massive data centers that require complex electronics. Every single connection, every switch, every motherboard contains silver. The military-industrial complex. Do you think that Tomahawk missiles and smart drones being used in global conflicts run on copper? No. They require the highest quality, most reliable conductor, silver. Here is the connection that should keep you awake at night. Silver demand is inelastic. What does that mean? It means Apple doesn't care if silver is $30 or $300 an ounce. There is only a tiny amount of silver in an iPhone, but without it, the iPhone doesn't work. So if the price triples, Apple must pay it. They cannot stop production. The same goes for Tesla. The same goes for Raytheon. We have a situation where demand is non-negotiable and growing exponentially, while supply is stagnant. Mine production is flat. Grade quality is dropping. It takes 10 years to bring a new mine online. We are entering a structural deficit. We are burning the furniture to heat the house. The surface stockpiles are gone. And now, nations like China and India are quietly sweeping the market, importing massive tonnage, draining the West of its real wealth. They know what's coming. They are exchanging their paper dollars for hard assets before the music stops.
So, how does this movie end? It doesn't end with a whimper. It ends with a violent repricing. We are approaching a singularity point, the short squeeze of the century. Imagine this scenario. The Federal Reserve, panicked by a recession or a banking crisis, cuts rates aggressively. The dollar index, DXY, begins to crack. Suddenly, the safe haven trade wakes up. Investors rush to buy silver. But this time, when they call their broker to buy physical metal, the broker says, "I'm sorry, there's a 6-week delay." Then it becomes a 3-month delay. Then it becomes unavailable. Premiums on physical coins will skyrocket to 50%, maybe 100% over the spot price. The disconnect between the fake paper price and the real street price will become undeniable. At that moment, the industrial giants, the Samsungs, the LGs, the solar manufacturers will panic. They won't buy to speculate, they will buy to keep their factory doors open. They will bypass the futures market and go directly to the mines, offering double or triple the market rate to secure supply. The paper market will break. The COMEX may declare force majeure, a legal clause that allows them to settle your contract in cash because they don't have the metal to give you. They will hand you worthless dollars and keep the silver. This is the super spike. We could see silver move $5, $10 in a single day. The gold-to-silver ratio, which is currently sitting at historically absurd levels, around 80-1 or higher, will collapse back to 40-1, maybe even 20-1. That means silver will outperform gold by a factor of 3 or 4. I don't predict the future. I analyze the crime scene of the present so you can prepare for the verdict.